Okay, so we're gonna go over chapter 9 first, and then we'll go over the test after. All right, chapter 9, we're gonna talk about current liabilities. So remember, our accounting equation is assets equal liabilities plus equity. We came out of 2 chapters where we went over current assets and we went over long-term assets. So we're going to do the same thing with liabilities section. We're going to do the current liabilities and the long-term liabilities. What does this account, like if it's a liability account, what kind of balance does it normally have on the general ledger? When you run a general ledger detail and you see your balances, what's a normal balance for a liability?
Credit?
A credit. Right. So usually you'll have accounts payable, you'll have your long-term liabilities in a different section, your current liabilities at the top, you'll have your accounts payable, you'll have your notes payable, anything within what, if it's a current, has to be within how long that it becomes due? 30 days would definitely be current, but how long can it go to?
1 year?
In 1 year. So if it's due within the year, it's going to be considered current. Sometimes we'll have long-term liabilities, but we have a current portion. So maybe the loan is for 2 years, and the current portion is what we would show in the current section of that loan, that this year, and then the next year would go in the long-term section. Okay, so where does the liabilities show? What financial statement? Does anybody remember? What are our financial statements? Name one of them.
Income statement.
Income statement.
Balance sheet.
The balance sheet.
Trial something or other? Trial sheet?
It's we do have a trial balance, but the trial
balance.
The trial balance is just a listing of all the accounts and shows us all the credits and debits. That shows all accounts, doesn't matter which statement it goes on, but we have the income statement, the balance sheet, those are the 2 big ones. And then we also have statement of retained earnings that we talked about, where you walk through what your retained earnings is going to be going into the new year. We also have a statement of cash flows, which we haven't gotten to yet. So where does the liabilities section, which statement is that on? The income statement shows your revenues and your expenses, right? That's all, everything getting paid out to show us what our net income is. Where are those assets and liabilities?
Balance sheet.
Balance sheet. So the balance sheet is set up just like the equation. Assets, they'll have a total, and then we'll have a liability and an owner's equity section, and those 2 added together will equal the total of the assets. So we're on the balance sheet looking at different accounts that are on the balance sheet. And we'll go through some transactions, walking through these different liability accounts, and you'll see there are some things that will go and flow into the income statement, because some of these things are going to be expenses. It could be also, if you're a merchandiser and you're buying things, you'll have a liability set up, but you might also get an asset, right? Remember inventory? You buy inventory, you put in your inventory that's an asset, but you also haven't paid yet, you're going to pay in the future. That would be a liability. So the examples are accounts payable. So I was telling you in the beginning to remember, it's an account that is payable in the future. I'm buying something, or I'm having some kind of service done and I haven't paid for it yet. So it's not going to be a cash transaction, but I have to record that somewhere to keep track of what am I going to owe in the future, whether it be a note payable or accounts payable. So if you think about the words accounts payable, it's an account that's payable in the future, and it's payable for you to pay. Anytime you see a payable, that's for the organization. They're going to have to pay that out. Okay. So we have accounts payable, sales tax payable. Sometimes we have a storefront and we're selling merchandise and we're collecting tax on that merchandise. And we have to set that up in order to pay state or local taxes for the sales tax that we collect. So we'll have a sales tax payable. We'll walk through that. Unearned revenue. Do you remember what that is? Unearned, so we didn't earn it. Revenue is what? Just income. So maybe someone comes in and they want services, but they don't want it this month. Maybe they want it, you know, in 3 months from now, but they've given you the money. You have to be able to record that and track it some kind of way. So when the cash comes in, we have to go to cash, because when we reconcile our bank statement, remember we went through reconciling the bank statement, we have to see our deposits that hit the bank. We have to have those on our books in order for everything to balance, right? So if cash comes in, I have to have another side. There's always double entry. I haven't done the service yet. It goes to unearned revenue. That helps identify that I'm going to have something that I'm going to have to do in the future. I'm liable to do some kind of service in the future or provide some kind of service in the future with parts or whatever. So I have to get that on the books in order to record it, in order to keep track of what I'm going to be liable for in the future. So I have that unearned revenue. Then we have short-term notes payable. So I may decide that I am going to borrow some money for 90 days. I'm in a cash crunch and I need to borrow some money. And I can do that. And I put it on my books, set it up, my cash comes in. The offset is I have to pay that out later. So I have to put it there to track it. I also may have to pay interest on that money. So a lot of times when you get a car loan, they're going to charge you interest. Sometimes they have specials for people that have real good credit that they don't pay any interest. But most of the time when you borrow money for a loan on something, the house, the car, cash loan, you're going to pay some credit back. I mean, some interest back, even on credit cards, right? You're using that, you're borrowing it, you have to pay interest. So we're going to go through some of those transactions. And then we have payroll. Everybody likes to get paid, right? So we have payroll payables. So we have a little bit of different transactions happening with payroll that we have to look at. We as an employer will have to pay the employee. And so when you pay that employee, let's say the employee makes $1,000 a week, the employee is not just going to get paid the $1,000, right? You don't just get the flat amount that you're making for the week. The employer has to withhold federal taxes, sometimes state taxes if your state collects state income tax. They'll also have to withhold FICA and Medicare, Social Security, Medicare, up to a certain point. Sometimes they have deductions for benefits. And so all of that comes out of your paycheck, and the organization has to keep track of that. And you're not getting paid maybe that day that you're finished the service. You're getting paid maybe the next week. So you have to be able to record all of those transactions and set it up to where I have to not only pay the employee, but I'm also going to have to pay all these taxes on the behalf of the employee. So I'm responsible to take in the money and then send it out to where it needs to go. Okay. So we're going to look at those transactions. So those are some of our examples of current liabilities. So let's look at accounts payable. So we have a utility bill that comes in. And we're going to take that bill, we're going to enter it into the computer software and set it up that we owe $153 for a utility bill, and it's due within 15 days. So for class purposes, we have to record everything because we don't have a software doing it for us, right? So if I wanted to do the journal entry that the software is going to do automatically for you, I have to do the journal entry. Well, I have to record that on my books. So how do I do that? I'm going to do an entry to debit my utility expense so I can get that expense in the period that it belongs. So I'm using my space for May, that bill's for May, so I'm gonna be posting that expense in May. So that is part of that matching principle, making sure those expenses are matching when you're getting the benefit from selling or, providing your services or whatever. So we have a debit utility expense for $153. The credit is accounts payable, $153. So we got the bill in, we're not paying it today, it's due 15 days. So got to get it on the books, got to put it somewhere, hold it in its place until it's time for me to pay. So if I needed to record that expense when it comes in, any kind of accounts payable, this right here is the transaction, right? We're going to debit whatever expense it is, and we're going to credit accounts payable. When I pay that out, I need to clear off the liability. So we don't want to look at a schedule that shows we owe Entergy $153 if we already paid it, right? You want to clear that off. So we need to clear this payable account when we pay it. So when we pay, we'll have a debit to accounts payable for the $153. And what are we cutting? A cash check, or we're doing an ACH online? Something's going to happen where cash is going to be pulled out of my checking account. So I'm going to do cash, $153. So that's what happens when I pay it. So the payable part of it, setting up that liability, is the transaction when you get a document and you have to record that document. So you have a source document and you have to record it. I'm liable to pay it in the future. So it's going to go into accounts payable. Anything that you receive that's part of your operations. So if, it's utility bills or rent expense, or it could be for materials that I'm going to use on a job. It could be supplies used in the office. It could be anything that you might be a consulting fee that you're having to have somebody come in, maybe draw some drawings from the architect firm for a job that I'm going to be doing at the mall. So you always have different things that are going on in your operations. And you have to have a way to record those invoices that come in, and you have to be able to keep track. So remember when we talked about accounts receivable, we could run a report that would list out everybody that owed us money individually. Well, with the liabilities accounts payable, it's the same thing. Accounts payable will have one control account. The way the software works is when you're putting in a bill, you're going to have to identify what vendor it is. Okay, so each time you put a document in, you're selecting who the vendor is. And the reason for that is so that you can run a report out of your accounts payable module and you'll get a listing. It'll be just like an accounts receivable listing. Instead of getting, customer names or tenant names or client names of people that owe you, now you're going to get vendor names. And those names are the people that you owe. And it will give you the amount for each person. How long has it been on the schedule? Is it within 30 days? It'll have columns that have 31 to 60 days, 90 days, 120 days, however you have it set up. You'll get that report. It'll tell you those amounts. It'll tell you who the vendor is that you owe. And at the end, it gives you a total amount due that you have to pay out within the next however many days. So that number on that report should match and tie back to your control accounts payable. Does that make sense what accounts payable is? So a lot of times the way the organization is set up, just like we have an accounts receivable person, that pretty much all their function does is invoice customers or post checks or write up deposits. Those are those functions. What do you think some of the functions would be in an accounts payable position? What do you think people would be doing?
Obviously paying bills.
Obviously paying bills. So somebody's got to enter them. Sometimes you have a clerk that all they do is enter bills. Sometimes in a smaller organization, you may do multiple functions. So you have somebody that's entering all of the bills that come in. You have to have somebody that pays the invoices. right? And then they have people that sometimes will just reconcile the vendor statements to what you have on your system. So you're always reconciling, right? To make sure that you have everything. Make sure that everything they say you owe is everything you have in your system. Are you missing an invoice? Do I need to ask for a copy of that invoice, get it entered into the system? Is there something on there they're showing that's open, but I know I've paid and I have that check number, but it hasn't gone through yet. And so maybe it got lost in the mail. That happens a lot, especially in this area with all the stuff we've been going through with COVID and Ida and Zeta and everything. So we sometimes have problems with that. So a lot of times we'll do ACH. We'll send money over through an electronic transfer. So you have people that are entering invoices, they're reconciling, they are cutting checks. They may be getting checks signed, getting that information back, putting them in the envelopes, getting those checks out in the mail. They may be the ones that are going online for those online accounts that you can pay electronically, and they're setting those payments up. So that's what accounts payable is, and what their role would be for just entering invoices that come in an accounts payable role. Now, we talked about some other accounts. So these positions potentially could also keep track of some sort of sales tax payable. If we're collecting sales tax, you may have somebody that goes through and they're looking at those sales, making sure that all of that is calculated correctly. So we have returns. Was that calculated correctly? How much is going to have to go out? We're going to submit the forms, fill those forms out, get that information in the system. Either we're cutting a check and sending it to state or local government, or we're going to be providing that online. So there's lots of different things that you can be doing in a payable position. So let's look at the sales tax, since we're just talking about that one. So sales tax, I'm selling product. In Louisiana, you don't have to charge sales tax on services or on freight. So if I'm charging sales tax, it's going to be on merchandise, right? So let's say I have a store that sells women's clothing and I go in to buy this sweater. What are they going to charge me? Just the $20 on the ticket? Nope, I got to pay sales tax, right? So what are they doing with that money? That's not their money to keep. It's not part of their income. It's just a pass through. They're collecting it from you to send it on to the parish and the state, whoever they have to pay for sales tax, okay? So we have to learn how to keep track of that. You have plenty sales that go through the day and through the month, right? Most sales tax in Louisiana for the parishes are going to be due on the 20th of the next month. So I have a whole month of sales if I'm active in that area. So I have a whole month of sales, and I need to be able to run a report, look at everything, be able to put all that information onto the documents that they ask me to fill out, cut the check, and pass through the money. So we need to figure out how are we going to keep track of that? How we know what we've collected, that's the sales tax portion. So we're going to put the entry in to identify that, and we'll have the records of that on our reports. So we have, let's say we sell material for $6,000 and they're subject to 5% sales tax. So how much cash are we getting? 6,000 times 5% is the $300. That's where 300 comes from. $6,000 times 5% is 300. So not only am I collecting $6,000 for the material that I just sold, I'm also going to collect the sales tax of $300 that I just calculated. Now, right now we have, computers, we have cash registers. It does all that for you. So normally you don't have to sit with a calculator and figure that out, right? Computers do that for us. Even now, when you go to like a jewelry show, we've gotten fancy. We got the software on the iPad. It calculates everything for us. It's putting everything through the web, QuickBooks, that we keep track of everything. They got their own little slider for the credit cards. We're fancy. It's not like it used to be, but let's just go back old school. We got to put in that $6,000 times that 5% to get our number. That money, that $300, has to go into a payable account because it's not mine. I'm liable to pay that money to the parish because I'm collecting it from my customer and I gotta pass it through to whoever I need to pay. So I did receive the money. So it goes to the bank is the full 6,000 plus the 300, the 6,300, because I've collected all of it. Remember, what goes in the bank has to be recorded that way. So when I reconcile my bank statement, it balances. I can check off, yep, there's my deposit for 6,300. There's my deposit for 10,000. There's my deposit for 1050. You have to make sure that whatever's going in the bank is what's recorded on your books so that everything reconciles. So we have a debit to cash for 6,300 because that's what I received. Then we have a credit for how much for sales? Only what we sold the merchandise for. We sold the material for $6,000. So we're going to record our sale for 6,000. We're going to set up our sales tax payable for 300. Now, at the end of the month, I'm going to run my reports, do everything I need to do. And before the 20th of the following month, I'm going to submit all my documents and say, I collected $300. Now I need to pay it out. So what are we going to do when we pay that sales tax? We're going to debit sales tax payable because I want to clear this account here. I don't want that on my books anymore. I don't want to run a report and show that I owe the city of New Orleans 300 because I've already paid that 300. So I'm going to make sure that I'm wiping out that account. What am I paying with? Cash. $300. So I'm going to credit my cash account for 300. So that's when I go to pay my sales tax payable, right? So the other portion of that entry that I did when I received the money, that's just recording what I put in the bank. That's recording my sales. Sales is not flowing anywhere in my liabilities, right? Sales is a revenue, and revenues go to what statement? What financial statement? It's income, so what statement it goes on? Income statement. Income statement. That's right. So the sales tax payable isn't going to my income statement because that's not my income. I'm bringing that money in only to pay it back out to someone. It's just a through account. Okay, so let's walk through the unearned revenue. So remember, unearned revenue is somebody's paying me, but I have not provided the services yet. I'm collecting the money in advance. Concert sells $5 million in tickets for 5 concerts, and they sell on June 30th. So I opened it up for 5 concerts in the area. I've collected $5 million. Now, I haven't done anything yet to earn that money, right? So I don't have to bring that into my income statement because I haven't done anything yet. But I am liable to do something in the future. So I have to record it on, put it on my balance sheet and show whoever's looking at my financials, okay, this person has to provide services in the future for $5 million. So we have to show it there. I'm receiving the cash. So we got to record the cash. So we debit $5 million for cash that we received. My credit goes to unearned ticket revenue of $5 million. So I'm recording. And if you're some type of artist and you do different types of shows and you have different type of classes or whatever, you may have different accounts for those different services that you're providing. So if it's a concert and I'm going out to sing in front of people, well, then I might have an account for that. And I'm putting the whole $5 million in this unearned ticket revenue. They may break it out further. They may have an account for each one of those concerts, those 5 concerts. They may use one account. It depends on how they want to keep track of it. If they feel it's easier to keep track of it to have sub-accounts under a concert revenue account, they may do that so they can keep track of, okay, so how much was for this one? We're going to say this is even. We're saying five concerts, $5 million, it's all even. But let's just say it wasn't. And I have to keep track of that. Well, I need to know, okay, well, I sold $3 million in Texas for one of these concerts, and then 500,000 over here in Louisiana. So they may not all be the same size. One size might not fit, right? So you want to keep that separate. So depending on the organization, how you want to keep track of it, you can get a little more detailed. We're going to just put it in unearned ticket revenue. We're going to put it there. We know we got 5 million on the books. We're going to do a service later, one of those concerts, because it's even, it's going to be $1 million. What happens now when I go and I perform the concert? So now I've gone out, I provided the service for all my fans. So now I have to record the revenue. What do I need to do? I just need to scoot some of that money out. So right now I have a balance, credit balance of 5 million in unearned. How are we going to move out part of that? We're going to debit unearned ticket revenue for 1 million because we're later now. We're providing that one concert. And I'm going to put, it's spelled wrong, but it's supposed to say ticket revenue. We're going to credit ticket revenue, $1 million. Now, what happens with my revenue account? That flows to my income statement. So you see how this works? Like, let's say I don't do another concert this year. I did that one on September 1st, but I never did another one. Do I want to recognize income for $5 million? What happens if COVID happens again and I can't go provide the services, right? I don't want to claim this money that I brought in as income this year because I haven't done it yet. I don't have to. Haven't paid maybe the full price of the venue. Haven't had the, the tour guides come out with me. I haven't had all those expenses. I hadn't had to pay the band. So I'm not going to record it as income until it actually happens. So I went to the concert, provided the service. Now I can record it as income. This year on my income statement, it's going to have $1 million. And then all the expenses that happened for that concert. Does that make sense? So what's left going into the next year? Because the liabilities on the balance sheet, what's left on my balance sheet that says I still owe? 5 million? 4 million, right? We just reduced it by debiting $1 million. So now my balance in that unearned ticket revenue is going to show $4 million, and that's going to roll into the next period. Is it hot in here? It's very hot in here. Oh my God. It's like burning up and it feels humid. I feel like I can't breathe. All right, so short-term notes payable. Short-term is just that, it's short-term. It's not gonna be anything that's long, over a year. It's gonna be something short. Usually all of your examples is gonna be like 60 to 90 days. So this means that we're promising, if we take some money in and we borrow it, we're promising we're going to pay that money back within a year. And we're going to have to probably pay interest on that money. So we're going to look at an example of that. On September 30th, a company borrows $2,000 cash in exchange for 12% 60-day loan. So when I borrow that money on September 30th, how do I record that on my books? Remember, I get money, I'm bringing it in. So now I have money going into the bank, which means I have to do a journal entry. I got to get it on my books. So I'm gonna debit cash for the $2,000 because that's what I brought in, right? And then I have to credit notes payable. That's going to show up on my liability section saying, okay, this organization owes $2,000 for something. Remember, we've been learning all those formulas as we go, that people are going to be looking to see how much debt do you have? How much do you have to pay out in the short term to see if maybe you're a company they want to invest in, or maybe they're a company that wants to lend you more money, or maybe they're a company that wants to lease space to you. You may not want to lend money or sign a lease with somebody that has not a lot of cash on hand and they have all this accumulated payables, right? That means they have a lot that pay out. They don't have a lot in assets to cover it. There's not a lot of cash and cash equivalents to liquidate into cash to be able to cover that debt. So that might not be somebody you want to invest in or lease a space to or lend money to. All right, so We have the note on our books. Now we have the 90 days or 60 days has gone by. I have to pay 12%. 12% is an annual number. I didn't borrow the money for an annual time period, right? I only have it for 60 days. So remember, whenever we're doing banking transactions with interest, we want to use that 360 for the year. So we want to calculate what is the interest that I'm going to owe on that $2,000. So we take the $2,000 times it by the rate, the 12%, and then we're going to multiply it by how many days did we have it? In this example, it's 60, and divide by 360 in order to come up with how much do I owe for just those 60 days, right? So if we take $2,000 times it by the rate, whatever that is, that's for a whole year. So we're going to divide it by the 360 to come up with a daily amount and then multiply it by the number of days. In this case, it's 60. So we come up with $40. So now at the end of November, I have to pay that money back. So I'm not only paying interest, right? I borrowed $2,000. I have to pay back the $2,000 and I have to pay back the interest. So do I only have $2,000 that I'm writing a check for that's coming out of my bank? No. How much do I have coming out of my bank? $2,040, right? So I need to remember that. That's my cash that I'm going to be paying out of that $2,040. When I set up my journal entry, I have to clear my notes receivable. Do I have $40 in that notes receivable that I set up? I only have $2,000. So that's what I want to clear. Don't get confused and try to lump the interest into it. You just want to do a debit to clear off that payable of $2,000. Does that make sense? I have $2,000 on the books that I owe Bank of America. When I'm cutting a check, I want to make sure I only clear $2,000 to that liability account that was set up for that note payable, because that's all that's in that account. What happens to the $40 in interest? That becomes an expense. That portion, I want to flow over to my income statement and show it as an expense because I needed to have that money maybe to provide services or to get some more product in, to do my next job. So I have to record that interest because that was part of my operating expenses. I got to put it on there. So I'll put interest expense. And then my cash going out is obviously a credit because the cash is leaving the building for the full amount, $2,040. On December 16th, this is an example that we're not paying it back in the same year. On December 16th, the company borrows $2,000 cash in exchange for 12% 60-day loan. We want to make an adjustment on December 31. So my period runs from January 1 to December 31. I have a loan that I took out on the 15th of December of $2,000. So I have 15 days in there that I need to record part of that expense because it's for that period. I'm getting ready to roll into a new year. And what happens at that new year? Remember, we do all the closing entries. We clear out all those expenses and we start fresh for the new period. So I have to make sure that I get that number on there. But have I made any payments yet to the bank? I haven't. And I haven't made an interest payment either. I don't have to pay anything until that 60-day mark. So there's no cash involved when I make my adjusting entry. Remember when we did adjusting entries, a lot of times there was no cash involved. We would just record an expense and setting up something, either depreciation, accumulated depreciation, or we had interest expense and we set up a payable because we have to pay it in the future. So we're going to do that for the loan. The notes payable. So we have $10 that's going to be expensed in this period. So we want to calculate that by taking the $2,000, multiplying it by the rate, dividing it by 360, and then multiplying by how many days for that period. So in December, we only need 15 days. So it's only $10. So on December 31st, we set up a debit to interest expense for $10, credit to interest payable for $10. So we're gonna pay that interest in a short time, 45 days from now. So now we go into the new year, and it's time to pay that loan. So we already know, we've done the calculation that for a 60-day loan with $2,000, the interest is $40, right? But we're not going to record the expense for $40 because it's not for the full 60 days in that period. We're going to do a calculation again for the 45 days. So we do the 2,000 times the rate, divided by the 360 days, and then multiply it by 45 days to calculate what is the expense for this period. So this period's expense is only $30. Okay, so now we have a couple of things we have to do. We have the notes payable on the books for $2,000. So remember the example before. I don't know why the notes payable up here. This was the original entry on 9/30, but this is the same entry that we would do right here on December 15th. We'd make that same entry because we're getting the cash for $2,000 and we have a notes payable for $2,000. So we credit notes payable. This is what's on my books, notes payable $2,000. When I'm paying that back, I'm going to debit notes payable for how much?
$2,000?
$2,000. We want to clear the entire amount because we're paying that note payable off. So on the 2/14 date, my notes payable is $2,000. And that's because that's what we set up when we received the money. That was our note. It was for the principal of $2,000. So when I debit, I only want to include the principal. I do not want to include the interest. Okay, so then what else did I do at the end of the year? I did an entry where I recorded $10 of expense last year, and I put it on the books as a payable. Well, now I'm paying it. So I also have to clear that payable. Because I don't want to run a schedule and see, oh, there's no $2,000, but I have this $10 interest that I owe. I don't want to see that if I've already paid it, right? So in order to clear it, I have to debit that amount, that $10. So the debit is interest payable for $10. And I'm clearing that payable that I set up the previous year. Now this period, I've calculated out my interest expense for 45 days and it came out to $30. Now I'm going to record the interest expense. My debit interest expense for $30. So this year, what goes on my income statement is $30 interest expense. And then my cash going out again is for the full payment. I'm paying principal and interest. So it's $2,040. Does that make sense? If you have a loan that flows in 2 periods, you want to make sure you capture your expense in the period in which you've had the expense for, right? For that period of time, you had that money to use. You want to put it in that correct period. So you have to do that adjusting entry to record your interest. Okay? And then you want to set up your interest payable. We call it accrued interest on our books because the interest is accruing daily and it hasn't been paid yet. Sometimes our loans aren't due at that last day of the month. Sometimes it's, so you want to accrue that interest. And so your interest expense is a debit, and we call it, instead of interest payable, we call it accrued interest. And we just leave it at that. We know a 2,000 account is payable. A lot of companies will do that. The 1s are assets, the 2s are liabilities, the 4s are sales, 5s are expenses, 6 are expenses. It just depends, you have your own little pattern, but a lot of times 1s are always assets, 2s or 3s are liabilities, 4s and 5s could be income, and the expenses are the higher numbers. I don't know why that is, but that's just how it is. Okay, let's look at payroll. So now payroll can be a little bit complicated because we have a lot of things going on. There's a lot of things we have to calculate and keep track of. So we're going to go through an example of this to help you understand, but let's just go through a couple of things real quick. So we have salaries and wages, employee benefits, payroll taxes that are kept levied on the employer. So basically we're collecting them. We have to pass them on for you. So we have the employee pay taxes, FICA taxes, which are Social Security and Medicare. So the numbers that I'm using for this example are actually the numbers from 2019. I don't know if they've changed, but maybe. So Social Security, every time you get paid on your weekly or bi-weekly, monthly, however you get paid, you have to pay your Social Security. Not all the time. If you work for the government, sometimes you don't have to pay that. It's different. But let's just say you work for an organization, private organization. You have to pay your Social Security tax, which is 6.2%. Then your Medicare, which is 1.45%. Now, the Social Security will say you're only going to have to pay that up to this point. So if you make over in 2019 over the 132.9, you won't pay the 6.2% anymore. Okay, so they'll withhold that. So the employer's job is to calculate that out, know what those rates are. A lot of times organizations will use a payroll company. They may use Paychecks or ADP. I know that you've probably heard some of those names, Paychecks or ADP. There's other payroll companies. So they may do all that for the organization. They calculate it out and then you just get reports and you have to do journal entries to record that. But sometimes organizations have software that they pay fees for the company to update their payroll software. In that payroll software, it has all the current federal and state tax rates and all their rates that they need in order to calculate all the taxes that they have to pay. So it can be done either way. Then we have the income tax. So we have federal and state income tax in Louisiana. And if you lived in Texas or Florida, you would only have federal, you wouldn't have state tax if they don't collect it. They do it a little bit different through like property tax and stuff. So we have our income tax that's going to be withheld out of that money that we have to withhold from the employee paycheck. And we have to make sure that it gets to the proper destination of whatever government we have to pay. And then we have voluntary deductions as well. So I may deduct healthcare benefits or vision benefits. I may have dental benefits. I may have life insurance, short-term disability. I'm sure you've heard of some of those things. Those deductions will come out of the paycheck. The employer has to pay, let's say it's AFLAC. Let's say I have all my little extra benefits through AFLAC with my company. So when I'm holding that stuff out, I got to pay AFLAC. I'm getting a bill and I'm going to pay them, but I'm withholding it out of your paycheck. Okay, then we have the employer payroll taxes. So just like you have to pay the Social Security and Medicare, so does the organization. Okay, so the company is also paying exactly what you're paying for Medicare and Social Security. They also have federal, state, and unemployment tax that they have to hold. And so they have rates for that, and you have to calculate that out. And that becomes part of our expense. And that doesn't get withheld out of the employee check because that's not the employee portion. That's the employer portion. So I'm going to have to keep track of what the employer is making and expense it, what taxes have been withheld, what benefits have been withheld out of that check, and then what is the net pay and keep track of what goes into my employee's account. And I also have to be able to say, okay, well, this is what I paid this person. Here's my portion of the expenses for the taxes. Also set it up in a payable and send all that money to the government agencies or to whoever's providing the benefits. Does that make sense? Couple of things going on. Lots of deductions from the employer side, and we also have the employee side, and then we have the employers that also have an expense, payroll expense, that they have to pay to the government agencies. All right, so let's look at an example. So we have this employee having a payroll of $2,000. Okay. Now, if you look down at the bottom here, sales payable, salaries payable, I'm sorry, not sales. The salaries payable is $1,524. So is that $2,000? No. All the deductions came out. So what was the expense? The expense is actually the $2,000. That's the total expense because that's what I'm paying you to do a job, $2,000. Now I have to calculate and keep track of the taxes. So I usually have separate accounts for this so that it doesn't all get mushed together. So I have FICA, Social Security. They're saying that's 6.2%. They've calculated it out and it's 124. I have Medicare taxes, 1.45%. Just multiply it by the 2,000, come up with $29. Now notice they're credits because they're payables. I'm gonna have to pay that out later. It's a liability. Liabilities carry a normal credit balance. Then I have employer federal tax payable. So now this is the federal portion of tax. However, however much the employee makes is how much that tax is that's kept out. So there's always a schedule and there's tables, and those tables are loaded into a software that normally will calculate it out based on what you make for the year. It'll calculate that out. So if you are a person that maybe is making $20,000, you won't fall in the same tax bracket that somebody that's making $150,000. It'll be a different rate. So, you know, our tax brackets have different rates on how our tax system is set up today. So it's set up to know that so that you don't get all of your money withheld on a higher tax bracket, right? You make less money, so less money is going to come out of your check so that you have more spending power, right? So you'll have tables in the software and it will calculate that out.